Gagan, and welcome to a special episode of The Voice of Insurance, produced in association with Beazley. Today's podcast is all about the insurance of political risk, and we're going to come at this subject from all angles. We're going to look at why political risk insurance is bought, who buys it, how it works in practice, and how most claims occur, are brought to insurers, and more importantly, how they're resolved. This podcast is intended to be an all-round masterclass for anyone with an interest in this fascinating and fast-growing specialist line of business. I've met and interviewed the experts, so you certainly don't have to be a political risk specialist yourself to benefit from a listen to what follows, although if you are an expert, I'm sure you'll find plenty of nuances and insights in here too. With the help of our guests, we're also going to look at the evolving nature of the risk itself. Is the world a riskier place, and are risks going to remain insurable? And where is most of the new demand of the coming decades going to be coming from? All will be examined in detail. Political risk and political violence cover has been a mainstay of the London and international specialist insurance and reinsurance markets for over 30 years, and London-headquartered specialist insurer and reinsurer Beazley has been a leader in this class since its early days. For several years, Beazley has been producing a series of prestigious reports on the state of the global political risk market under the banner of Risk and Resilience. This year's report, entitled Navigating Political Risk in an Era of Heightened Global Tensions, is excellent, and a quick read-through will be highly complimentary to a listen to this podcast. The link to the report is in the podcast notes, and I recommend you download it and read it straight away. This year's report highlights heightened awareness of geopolitical risk in the commercial world, with 30% of business leaders saying that political risk is the biggest threat they face this year, up from 27% last year. Over a third of senior executives felt that they currently operate in a high-risk environment, again up from 31% last year. Much has also been made of the exceptional number of elections taking place in global democracies in 2024 as another possible source of political complications and conflict. Whichever way you look at it, we're clearly in an era of heightened sensitivity to risk. So how's this translating into new business opportunities for the best underwriters, and where is a lot of this new demand coming from? The report also highlighted Africa as a potentially huge new source of demand, driven by the global transition to net zero carbon emissions, and this goal's need for the rare earth metals that are to be found in abundance in many of its southern and eastern states. It's no secret that many of Africa's most mineral-rich nations, with a large development potential, are also places where political stability can be in short supply. It's clear we have a massive business opportunity and huge potential for highly profitable investment, but at the same time accompanied by exceptional levels of risk. This sounds like the ideal territory for brave underwriters to be operating in. A perfect storm of demand, if you will. For this reason, this podcast will be making a particular effort to focus on the opportunities and threats that Africa poses to the political risk market, and I'll be talking to Lara Wolf, Sub-Saharan African risk analyst at risk consultancy BMI, which is part of the Fitch Group. But as I said at the beginning, this podcast isn't all about the big picture. With the help of Beazley's Head of Political Risk and Violence Claims, Alex Hill, we'll learn how the political risk product actually works on the ground, how claims tend to occur, and how they are settled and recoveries made. Now it's time to set the scene. And who better to do that than Roddy Barnett, Head of Political Risks and Trade Credit at Beazley. Roddy's worked for 17 years at Beazley, so armed with a copy of the Risk and Resilience report, I got straight into it and asked him to map out the African opportunity as he sees it manifesting itself. Let's hear what he's got to say.
If you look at our book and the demand that we see coming from our clients, there is a huge focus on Africa. This is, I guess, for two or three main reasons. One is in terms of just growth and the speed of growth. Africa as a continent, you've got some of the fastest growing populations, you've got some of the fastest growing economies in the world there, but you've also got this aspect that we picked up on, which is whilst the rest of the world is looking to transition away from fossil fuel generated energy, the solution to doing that lies in part with construction that is dependent on a lot of the minerals that are under the ground in Africa. So you've got this effort, as well as Africa being a fast-growing economy, you've also got this very specific need for the rest of the world to invest to go into Africa because it's part of our global economic aims. We come in, I guess, to provide capital, be it debt investors, equity investors, with the comfort they might need in order to invest. So the products that we sell on the political risk side provide peace of mind to, say, banks lending into some of these projects in difficult jurisdictions that should the political situation worsen to the extent that it causes them a financial loss on a loan that they've extended to a company, we would be there to indemnify them against those sorts of losses.
So what sort of customers are typical?
So I suppose there are different classes of clients that look at political risk in different ways. So if we stick on mining, you take the large multinational mining companies who perhaps manage political risk in a very different way and don't require political risk insurance because they are naturally hedged. They have assets all over the place.
You've got diversification.
Exactly. So they wouldn't necessarily be a natural fit for our line of business.
I suppose they might be if they have a particular accumulation
perhaps
where they don't have the diversification.
Exactly. And also they'll always be looking at things that's cost benefit, and if they can get cover that fits into their budget, then they might acquire it. Where we really see a lot of demand for our products is mining companies without that geographical spread, and in particular, because mining companies do tend to be quite risk hungry, the debt providers to those mining companies. Now, banks and other providers of debt facilities don't quite have that same comfort that everything is going to be okay in the end.
So wherever there's someone whose job it is to be more of a realist and back the risk taker with capital, there's likely to be demand for political risk insurance. Let's get into details. I asked Roddy what underwriters are looking at when they start to underwrite a risk.
I think there's a cliche in the political risk market of finding the good risk in the difficult jurisdiction or the risky country. And I think it's a cliche because that describes an awful lot of what we're doing. So in terms of the underwriting process, the starting point will be the client, their experience in investing in difficult parts of the world and how they've gone about that. And key to the whole concept of managing political risk is how you manage relationships at the government level, the ministerial level, as well as the local level. And the clients that we work with closely in some of the more difficult jurisdictions have really put in the hard yards when it comes to negotiating their concession with the government, but also ensuring that the actual investment activity that they're carrying out has been well thought through in terms of local communities. And also, when you're looking at a new risk, assessing the value that that investment is bringing to the country versus the profit that the investor is making out of that investment. And you've got to have a balance. Of course, an investor is not going to come into a country, whether it's in the mining space, infrastructure, any sector, they're not going to come at it without a profit motive. But then what we don't want to see is a very unfair equation where the government is not getting anything out of it.
This is really interesting. The fairness of the deal to all parties is an important part of the nature of the risk. We often hear positive stories about insurance being the DNA of capitalism, allowing other sectors of the economy to do more and make their capital go further. But we rarely hear insurance described as one of capital's arbiters, seeing fair play. Let's get back to Africa and hear from our African specialist, Lara Wolf. Her first point is that we should really study our geography before we start thinking about a continent as large and diverse as Africa.
It's an unfortunate cliche that a lot of people would refer to Africa as a country rather than a continent and perceive it as very homogenous. That's completely untrue. It's in fact a large and diverse continent with 54 countries, numerous religions, languages, and landscapes. I'll give you some examples. If we compare, say, Nigeria and Mauritius, Nigeria has one of the largest populations on the African continent. Its population is very young and it's a very fast-growing population. By contrast, Mauritius has one of the smallest populations on the continent. Population growth is just above zero. And one of its key policies for the upcoming elections this year is pension spending. So very different there. If we think about religion, Nigeria is split. So the north of Nigeria is Muslim and the south of Nigeria is Christian. This is a generalization, but broadly, whereas Mauritius is a predominantly Hindu country as a result of a large group of ethnically Indian population. And if we take, for example, political external risk, Nigeria is experiencing significant insurgent activity in its northeast as a result of insurgent activity happening in neighbouring countries. Mauritius is an island, so experiences unsurprisingly very limited risk in terms of insurgent spillover. The economic makeup of Nigeria is it's an oil country. It's very reliant on oil and oil production. Mauritius, on the other hand, is a services economy. So its focus is on expanding its financial services, its medical tourism, and its port offerings.
Thanks to Lara for a great opener. Clearly, underwriters dealing in generalities are not going to get very far. Roddy takes up this point and runs with it. We should also remember that many individual African countries are very large in their own right. So what we think we know about a place may in fact be happening a very long way from where a risk is located.
Always take the example of a country like the Democratic Republic of Congo as a good illustration of how we try and do things in countries that, on the face of it, and if you read the headlines about the Democratic Republic of Congo, there aren't that many people that say good things about the political stability of that country. Well, in fact, Democratic Republic of Congo is about the size of Western Europe. It's huge. And yes, there is a civil war, or a conflict that looks very like a civil war going on in the northeastern region. But on the other hand, the southeastern region, which is the area in which a lot of the global future supplies of cobalt come from, is relatively peaceful. And those two areas are incredibly far away from each other geographically, and also, importantly, are not particularly well connected by roads. It's not like driving from Spain to Belgium on a lot of toll roads. So that's the sort of way that we think about writing risks in difficult jurisdictions. Exactly what is the risk that we're looking at? About where is it? If there is a conflict going on somewhere in the country, is that actually impactful to the investment or asset that we're looking at insuring?
So it's not just the anatomy and the inherent fairness or otherwise of the investment-seeking cover. It's also the specifics of the 54 countries and the multiple regions and geographies within Africa that also need to be taken into consideration. Political risk underwriters certainly need to be good at detail. Let's call back on Lara's African expertise for an overview of how the risk landscape is developing in the continent. Here, rather than focusing on too many individual countries, we're talking about the big macroeconomic picture and how this is affecting stability across the continent. Unsurprisingly, the pre-existing high levels of inequality in many countries, the pandemic, high inflation following Russia's invasion of Ukraine, and relatively high global interest rates are all huge factors. This is quite a long explanation, but I think it's worth every second.
In a lot of countries where you have high levels of inequality, where you have a lot of poverty, groups who come in and can make very good promises, they're very well financed, can come in and offer services that can often be very popular. We saw a rise of insurgent popularity around COVID-19, for example, where you have governments who are struggling to collect taxes and collect revenues from populations that simply aren't earning enough to contribute. So you have states that have very limited resources to offer services, especially when the pandemic hit. And instead you have these other groups who step in and say, well, if you support us, we'll offer you vaccinations, we'll offer you health services, we'll provide education for your children. And so they gained a lot of support. Domestic factors have an impact, but as soon as you have an external shock, such as the COVID-19 pandemic, such as the Russia-Ukraine war that saw a massive spike in wheat prices, oil prices, then it only exacerbates the situation on the ground. And what we were worried about across the continent was the impact on domestic prices and in turn resulting in social unrest, in protests, as people simply can't afford the basic necessities they need to live. What we actually saw in a lot of places is governments introducing food and fuel subsidies, which basically, in effect, kick the can down the road because these are countries that couldn't necessarily afford to provide such subsidies. But you saw these subsidies introduced temporarily, which helped to lessen the impact of the price spikes for certain groups in certain countries. However, then gradually as countries try to pull back those subsidies, you can see political risk rise later on. So in a lot of countries, we saw fiscal deficits widen significantly in the years around the COVID-19 pandemic and the Russia-Ukraine war. And now we're seeing countries try to introduce some form of austerity measures, or what they're often forced to do is they cut fixed investment in order to maintain recurrent spending, so spending on things like transfers and subsidies, but at the expense of spending on large-scale infrastructure projects or projects that are needed to develop the country's growth longer term.
We in the West often forget that when times are difficult, they're usually proportionally more difficult for less wealthy nations than ours. So under such circumstances, it's hardly surprising to see insurgencies and well-funded external actors making headway and increasing political instability in poorer African nations. But now a key question. If the pandemic, Ukraine and inflation have caused so much trouble, will the recent moderation in price rises and an easing of global interest rates bring some welcome relief? Back to Lara.
It should be in the coming quarters, potentially next year. But actually what we're seeing at the moment is inflation is remaining stickier than we were expecting this year, than a lot of economists were expecting. The US Fed is postponing their easing cycle, or it looks like it will be postponing its easing cycle. And you've got a lot of emerging markets, including on the African continent, where they are not willing to start cutting their policy rate until the Fed starts cutting the US Fed rate, because it would exacerbate capital outflows out of these markets, and it would weigh on currencies that are not necessarily performing so well already. So yes, in the longer term, declining inflation, slower price growth exactly will support consumer activity, will allow for monetary easing, will encourage greater borrowing by business sector. But in the short term, we're not actually seeing inflation dissipate as quickly as we had hoped. And therefore, we are seeing risks of higher interest rates for longer, and the impact of that on economic growth in a lot of African markets.
So perhaps later. But all eyes, as always, on what the Feds do, as trying to front-run them is not something even G7 economies can do without risk. I then asked Lara what other factors she was taking into consideration, and she gave me the first reminder that 2024 is a very big year for elections in global democracies, and that some of these can have global consequences.
So if we're talking next 6 to 12 months, a Trump win is definitely something we're flagging as a potential risk. It would mean potentially a shift in US-Africa relations and increased risks to something called the Africa Growth and Opportunities Act, which is a US tariff-free program which allows certain African markets to export certain products to the US tariff-free. So there are risks around that with a Trump president. Other risks that we've been flagging recently, so say a full-scale conflict between Israel and Iran, would have significant implications for the continent in terms of countries being forced to choose sides, as we've seen during other conflicts recently. It would have global economic reverberations, especially if it starts to impact oil production in the region. It would also likely introduce shocks to other commodities in the global commodity market, which, as we've already discussed, African markets are very exposed to. And also a sharp decrease in risk appetite, which often happens when geopolitical tensions are on the rise. It generally results in a sharp movement of investment away from so-called riskier emerging market assets towards safe haven assets such as the US dollar, the Swiss franc and gold.
So once again, anything the US does, be it raise or lower interest rates, or indeed which president its people elects, has an effect on the wider world, while the risk of serious conflict destabilising key markets is ever present. We've already seen two very big elections in India and South Africa deal blows to long-standing incumbent ruling parties who now have to do deals with other coalition partners in order to govern. Political change is the only constant. But now let's get a little more practical and find out how the claim side of things works in practice. Luckily for that, we have Beazley's Head of Political Risk and Violence Claims, Alex Hill, to enlighten us. I asked Alex how a typical risk or political violence claim comes about, and this is the exchange we had.
Typically on a political violence side, it's much more straightforward because we'll see or hear of an event either.
I suppose we can see it on the 10 o'clock news, can't we?
Often that is the time we see it the first time, yeah. So there's been an obvious situation. We would know if we've got exposure to that particular event. And if so, the claim will come through fairly quickly via the broker or via electronic claims files. On the more traditional political risk, that's very different. We'll often be aware of a situation that could give rise to a claim a long time before it becomes a claim. And there may be a wobble or a default in payment, and the insured will work very hard with that defaulter or debtor to rectify the situation before it becomes a claim and they come to us. And that can take months. It can take years before a claim actually crystallizes. And that will then also be notified typically by a broker, but we'd be aware that it's coming before we actually see it.
And I suppose you can have claims that are on your potential radar, but then they end up getting resolved and they end up not being a claim, I suppose, which is always a good result.
Yeah, absolutely. I mean, these financial defaults and wobbles can quite easily be rectified through business circles, and we never see them then.
So it looks like the job of a political risk claims professional is to be very aware of all sorts of circumstances that may give rise to a claim, but to develop an instinct for those that are more likely to than others. Next, I asked Alex to explain what sort of claims we're talking about. And I'm sure you already know, but the abbreviation PV, of course, stands for political violence.
I suppose the most common on the straight political risk would be a single deal default, where we would insure a financial institution who are supplying a credit facility for a particular contract, and for one reason or another that contract fails or the debtor becomes insolvent. Something like that would probably be the most common on the political risk side. And on the PV side, it would be an opportunist attack on an asset, an area that we insure. And usually those are fairly obvious what's been going on, more so than the political risk side.
So the nature of the claim is fairly straightforward. But given the nature of the risks, I was interested to find out how long a typical claim took to settle.
If you compare them with other lines of business that are more typically insured, then a political risk claim can typically seem to take a lot longer because there's a lot of complexities involved with it and various parameters that need to be explored. But I wouldn't say it's a long and drawn-out process. It can be quite a lengthy process, but it's a process that's generally pretty busy with lots of negotiations, lots of discussions about how we can minimize a loss or recover the loss later. Yes, it can take time. It doesn't always take time, but typically with regards to other lines of business, a political risk claim is probably a longer-term proposition.
How long are we talking typically?
Well, a straightforward default, if there are no particular issues with it, it's just a company that's gone bankrupt, can be done fairly quickly. You're probably talking the very quickest would be a couple of months, but then longer than that, dependent on the circumstances of the case, whether or not there are any coverage concerns or complexities, it could take years sometimes to get to the settlement.
That surprised me. I assumed claims would drag on. But I'm pleased to hear that they don't tend to. Now we know what we're dealing with, and given that we're talking about claims from all over the world and I was talking to someone of huge experience, I thought it would be fun to find out what were some of the most interesting or downright bizarre claims that Alex had handled in his long career. I really enjoyed this part of our chat because I really think it gets to the heart of what political risk is all about.
It's interesting. I've had some incredibly strange claims. It's usually the underlying facts that are the weird things. To give you some examples, I remember we insured a factory in the Middle East somewhere, and the government decided that it would be better placed to be a hotel rather than a factory, and they were putting out all sorts of not half-truths about this factory polluting when it wasn't, etc. And in the end, they just basically demolished it whilst everybody was still at work in it. And it was somewhat sort of surprising. We saw the video of this. There was a meeting going on and a wrecking ball came through the wall halfway through this meeting, obviously leading to an immediate evacuation, but the factory was destroyed. There weren't actually any injuries that I can recall. This was a long time ago, this claim now.
And then how do you settle something like that? Presumably you don't have anything really to recover, I presume, at that point.
It's interesting you say that, actually, because that one wasn't too difficult with regards to the adjustment because the facts were what they were. We knew had done this action. We knew that they were planning to do it for a while. And we knew that what they'd done wasn't strictly legal. So it was a matter of paying out the claim to the insured, which happened, if I remember rightly, fairly quickly, but then going after the sovereign state that was involved in that demolition to recover our outlay. It can take a while, but yes, we recovered that one.
Oh, excellent. Luckily that there was enough of independent judiciary in that country that you were able to do so, not take a view that you just had to write it off.
No, that's one thing. Recovery is vital to what we do.
What an amazing story. Only in the world of political risk. Alex is driving at the heart of what, in my ignorance, I touched on earlier when I asked how long claims took to settle. Claims may be settled quickly because that's what needs to happen to compensate the insured. But once a claim is paid, the insurer can pursue a recovery from the party responsible for causing the loss. And of course, that may take a very long time indeed. So, subrogation and recovery are a big part of the class. Let's hear more from Alex about this.
Even before we're notified of a claim, we will look at avenues of how that claim might be resolved and recovered. Recovery is every bit as important in political risk as indemnification, and the recovery percentages that we see on political risk claims are generally quite high. I mean, we like to think 30, 40% or higher on a sovereign debt. So we do get this recovery fairly frequently, and it is something that's considered from literally day dot of the claim. And we work with the insured in order to maximize recoveries because obviously the insured sometimes has a better relationship with the debtor than we do or with the debtor country than we do. So working closely with them is hugely beneficial. And yes, we have on occasion been left with physical assets. It's something we don't like to do because we have to usually set up an SPV to hold them. But we've done it in the past, and we've done it with some very significant assets, ocean-going ships, that sort of thing.
I certainly heard something about a gold mine in some far-flung islands.
Yeah, we insure mines all over the world. Typically we wouldn't take the mine as an asset itself because we're not miners. There's not a lot we can do with it. So in terms of taking an actual mine, that would be extremely unlikely. We'd work with the insured to rectify the situation. It's more a case of a saleable asset. So a ship, a plane, some bearer bonds, something like that would be much more likely for us to hold.
Something that's more mobile that you could actually physically go and get and take away.
Yeah, and something we can do something with, either sell it or operate it or charter it or whatever it may be. But like I say, we try to avoid that if we can.
By the way, an SPV is a special purpose vehicle. That is to say, a company specifically set up to hold an asset. No wonder insurers only do this as an absolute last resort. This is fascinating stuff. It had never occurred to me, but after hearing this, it's no wonder elections are so interesting for political risk underwriters. They might bring bad news, but they also might bring good news if the previous regime sequestered an asset that you insured and then a new government, who may be more favourable, comes in. Time for Alex to sign off. I ended by asking him what sort of skills are required to be a great claims professional in this sphere. From what I'd heard so far, I imagined that this too would provoke a very interesting answer. I wasn't disappointed.
The number one thing that you really need to do is to have good communication skills with internal and external stakeholders. These are highly complicated, high-value claims, and you really need to know what you're talking about and how to discuss them with these particular stakeholders. The more experience you've got, the better, obviously. You need to have an analytical mind. You need to have a sense of reasonableness. These claims are never or very, very rarely cut and dry. So you need to look at the overriding picture rather than the minutiae of the claim. And also you need to have a thick skin. These are high value claims and tempers can run high, and you need to just be able to take a back foot and discuss any concerns you might have with the insured and or with the brokers to get a decent outcome for everybody. The ideal outcome is for both parties to walk away feeling that the product has worked for them. That doesn't necessarily mean the claim will be paid in full, and it doesn't necessarily mean that the best outcome is not to pay a claim. I always think that if you can negotiate a settlement, which we usually do, whereby both parties feel possibly slightly aggrieved, then you've probably got the right thing. If one party's feeling slightly better than the other, you're probably not. So at the end of the day, when you settle a claim and you feel that you've done it for the value that it's worth, is the right outcome. I always say, we're here to pay what we owe, and that's what we try to do.
As a journalist who sometimes has to tread the tightrope of impartiality, I can definitely relate to what Alex was saying about leaving both sides ever so slightly unhappy. I don't doubt the level of skill and experience required. And clearly, with recoveries making up such an important part of the value chain, a top claims team is probably as important to an insurance business as any star underwriter. Many thanks to Alex. For balance, I asked Roddy what skills he thought were essential in an underwriter. Here's what he said.
Who you're doing business with in terms of clients is a much better starting point than actually the country of risk that you're being asked to look at. I think it's an interesting skill as a political risk underwriter because you have to focus on the detail when you're looking through concession agreements and making sure they're fair for both parties and making sure all the clauses line up. But you also have to keep quite a wide lens on what is this business about, and is it good for the country? Is it good for the investor? So it's being able to focus in on the detail, but also keep a very wide view as to what you're being asked to cover and how this fits within a wider portfolio.
Does that go for the financial institution that's probably involved as well?
Yeah, definitely.
You find that some are better than others, obviously.
Yes, absolutely.
There's clearly a common cultural thread running through the two. To succeed in this world, you need to be good at handling detail, but not be obsessed by it. A large degree of pragmatism is clearly in order. Before we start to sign off, let's pick Roddy's brains a bit more. So far, we've focused on the great opportunity in Africa. But what about the prospects for increased demand in the rest of the world?
Africa is our largest single exposure in terms of a continent, but we see
the largest source of growth as well.
Yes, as well. But we have always and continue to see a steady flow of business from Latin America, Central Asia, and the Far East. Really, wherever there are countries that are politically unstable, economically developing, is where we see demand and do bind business. Obviously, what's been happening in the Middle East since Hamas's attack last October has definitely led to an increase in demand for cover in certain Middle Eastern countries that had been slightly muted in terms of demand for us. So that has definitely led to an uptick. And then the other area that clients are increasingly concerned about is China. So that's a big conversation at the moment in the political risk market.
And presumably Taiwan, one presumes as well.
Taiwan, exactly.
But you're not necessarily seeing that flow of business yet.
No, I think with China and Taiwan, I think you haven't seen a huge uptick in demand. It's been a relatively steady.
It's just sort of built in, hasn't it? I suppose if you're a bank, you've been lending in Taiwan for a long time, you've sort of done it.
Exactly. I think probably a way of characterizing it would be, say, 5 or 6 years ago, no one would have wanted cover for their Taiwanese political risk, and now we are seeing a flow of requests.
I thought it was worth getting into the Chinese question in a little more detail. As tensions rise between China and the rest of the world over Taiwan and other issues, how worried should we be? And can the market cope with demand? Or indeed, does it have the appetite?
Where the market perhaps is struggling to come up with the limits required by clients would be mainland China. There is so much overseas investment in China, and there is only a finite amount of appetite, particularly with current tensions between the US, China, and the rest of the world.
Do you think we talk too much about China?
I can see why we talk an awful lot about China. It's an integral part of the global economy. Most supply chains touch or end up in China. I understand why we do talk about it. I think there are still opportunities as a political risk market to support businesses in certain sectors in mainland China, and I think we should step up to the plate.
But it's so big. Are you saying that it is a bit tricky because obviously it's one political system?
Correct. And there are areas of which fast becoming close to uninsurable. If you're looking at military sector investments or contracts, perhaps some of the tech side of things might become a bit more difficult as and when restrictions, sanctions, embargoes become a prominent source of policy, both in the US and on the Chinese side.
The bullish argument with China has always been that it's a mercantilist kind of country. It's become a big stakeholder in the whole global economy working and has become intertwined in the globalized system. So therefore, it's not likely to do anything that would to sort of cauterize that.
I think I subscribe to that point of view.
It wouldn't be in its interests, i.e., to do that.
Exactly that. I think the way of viewing China foreign policy is through that lens to some extent. Their investment overseas, their support of countries that have the resources that they need in order to continue growing economically as they have done for the last quite a few decades. And I think some of the tensions that have occurred recently, I think, can be seen as Chinese pushback against external forces that make it feel threatened from an economic standpoint. I think on the flip side of the coin, I think that the interconnectedness between China and the rest of the world is a good reason to be a bit more optimistic about the future.
So hopefully mutual interests will intervene to prevent open conflicts. It's time to close off this podcast. Given all we've heard and everything in Beasley's excellent report, the links to which will be in this podcast's notes, my last question to Roddy was whether we were in something of a golden age for political risk, at least in terms of the demand picture. Here's the conversation that followed.
In a way, the demand is certainly increased off the back of all the events that are hitting the front pages of newspapers around the world. I think we as a market are obviously having to manage our own exposures and to also manage our own appetites to particular events. So we're always thinking about realistic disaster scenarios and making sure that we haven't overexposed ourselves to any one of those. And those emerge and they do change, constantly looking at them. So a golden age in some respect in terms of demand, quite a tricky time in terms of risk picking and risk selection.
Have you got the supply? Because obviously you don't get something for free. You get that golden age of demand because there's a heightened perception for risk and probably because there is more risk.
Yeah.
Therefore, because there is more risk, are you able to get the capital to come and risk itself against those risks?
Yeah, so I think the market for political risk has grown over the last 2 decades. I think we're up to over $3 billion of theoretical capacity per risk. Could have gone up slightly in the last couple of years, but I think that's around where we are. Now, how much of that $3 billion you'd be able to get for a risk in Burkina Faso, I don't know. But I think the feedback from the brokers is that most of the time they are able to source the limits.
So there you have it. Political risk insurance has the capacity and appetite to continue to be a crucial economic enabler to developing nations. But perhaps a little more unexpectedly, it's also an important advocate for fairness in global business dealings. Its practitioners have to have an eye for specific detail, but they mustn't let it overwhelm them and stop them from acting. They also have to have an understanding not just of global politics, but also an eye for local culture and geography, and maybe the odd wrecking ball. Thanks to Roddy, Lara and Alex for making this such an interesting episode to make. If this has piqued your interest, do make sure you download Beazley's Navigating Political Risk in an Era of Heightened Global Tensions, the links to which are to be found in the podcast notes. Thanks for listening. Well, I hope you enjoyed today's episode. If you did, don't forget to subscribe or leave a like or a review or recommendation on whatever podcast platform you used to access this programme. These really help get the word out. Before we go, just a quick reminder that advertising slots are available here and in other places in the Voice of Insurance podcasts. Podcasting is the fastest growing medium and attracts a high quality audience of key decision makers. It's also an intimate medium where you, the listener, are right in the room with me and the interview subjects. Needless to say, that means it's a great way of getting your message out directly to an audience because you know you've got their full attention. It's also very cost effective. So get in touch with Mark at thevoiceofinsurance.com to find out how you could be speaking directly to the industry. Voice of Insurance is produced by me, Mark Gagan. Music was written by Anna Gagan and produced by Carlos Gagan. Check out more podcasts and written comment pieces at www.thevoiceofinsurance.com.